Is it delayed out, Pink? Can you hear me?
I can hear you, Brett.
Oh, hey. Is it just stalled out? I think the screen stalled out there, yeah?
Yeah.
All right. Let's see. Let's take that back there. Yeah. All right. Hey, everybody. Just get this thing going here. Looks like our video sometimes stalls out. So we'll skip that again. Hello, everybody. Welcome. My name is Brett Swartz, and I'm happy for everyone who's watching this online or who's joined us at the Capital Gains Tax Solutions Mastermind, which happens every single Friday at 10 a.m. Pacific Standard Time, 1 p.m. Eastern. You know, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy such as the deferred sales trust, sometimes a 1031 exchange, sometimes cost segregation, sometimes donor advice fund, different ways to exit and defer tax and eliminate estate tax. There are amazing ways for you to preserve your wealth and then create more wealth. And each Friday, we kind of do a more of a deep dive above and beyond what you might catch on some of the shorter videos that we have, or even podcasts. And so we're happy to be here again. I'm joined by some amazing individuals. We have the Jake Miller, the Pierce York. Pierce, Jake, how are we doing today, sirs?
Doing awesome.
Having a fantastic time. Can't wait for this presentation we're about to give. Lots of good news and lots of good case stories this week.
Well, fantastic. We're looking forward to those questions and thoughts and diving in. And that's the point of this whole mastermind, is to kind of give everyone a little bit of an opportunity to hear what's possible with the deferred sales trust, as well as like what's not, who doesn't fit for, who it does fit for, some objections or challenges that people have. Constantly, we're helping people overcome what's called false beliefs of the deferred sales trust. If it's too good to be true, how do we know it's legal? You know, do I give them all control? Is there audit defense? How many of these have been done? What kind of investments can we put it into? How active or passive can I be? All of these things. So we weave in some of those challenges that we face every week, and then we share deal stories, and then we kind of share our journey, and then we open up for questions. So by the way, if you have questions along the way, you can just put it in the chat. These are the questions. That being said, let's start off with today's topic, which is building a capital gains tax exit plan, which is all in the excitement of the new book, by the way. So this is a shameless plug. This book is coming out on the 20th. Okay. So on mark your calendar on the 20th. There's a 24-hour little window that if you log onto your Amazon account 24 hours on the 20th, you can download the entire book, 300 something pages for free. Okay. Kindle version. Okay. Now, if you want to also support the hardcover copy, or I guess it's the soft cover, real copy, physical copy, you can also buy that too. Check that out on Amazon. But the whole concept is, how do you build a capital gains tax exit plan? First of all, you have to envision what you want to do. You want to build, and you want to unlock the freedom. So you want to envision, where do you want to be? What does it look like? What do you see? What do you feel? What kind of cash flow? What kind of stress relief? Maybe what kind of location freedom? I heard there's 5 Ds. Ds as in 5 Ds when someone might sell or might exit something that's highly appreciated. Okay, there could be death, there could be divorce, there could be diversification. There could be debt relief, paying off debt, and there also could be destination, meaning they want to go somewhere else. And these tend to be the drivers, especially for anyone who's selling out of a highly appreciated asset in something like California or New York or New Jersey, where you have a huge tax state, but maybe you're feeling like you're real estate rich, and maybe the cash flow is not as lucrative as you like it to be, or maybe you have a lot of debt and debt starting to adjust. Okay. But you're facing this big tax burden. This is the whole point. How do you weave in a capital gains tax exit plan before you exit? Because guess what? You're facing somewhere between 25 to 50% of your gain being wiped out by capital gains tax and depreciation recapture. And so that's the big thing to solve for. But we believe you've got to go in the right order. You want to build the plan before you actually even list or sell the asset. Jake Miller, what are your thoughts on that so far? He's frozen. So I might actually open it up to Pierce. Pierce, what are your thoughts on that so far?
Yeah, it's interesting the 5 Ds that you kind of summarize there. And when you kind of break it down, I think that's pretty accurate, One of the things that is super cool about the deferred sales trust is that it can help in pretty much any one of those situations. It's got the ability to provide freedom in each one of them in different ways. So I think that's pretty awesome.
Yeah. And like, for example, it could be a partnership separation. It could be, we did a deal in San Diego. It was 4 partners in a car wash development ground up out of Chula Vista. They bought land. They developed the land. They were all in for about 4 million. They sold for about 13 million. And so the difference there was substantial. And the tax would have been in the multiple millions. And so they were able to defer their tax. But guess what? One of them wanted to really spend the money and be separate. So he just took his money and paid his tax. The other 3 wanted to defer the tax and be able to reinvest it slowly over time when it made sense. And that's what they've been able to do. So far, they've been basically mostly liquid, diversified on the sidelines. They've done a couple passive real estate deal investments that are more like lending that are semi-liquid. But they're waiting, and they've been waiting, and they were able to sell at the right time, essentially in 2022 before everything really started to shift. And now they're starting to see the opportunities. And that's the cool thing. It was able to help them separate the partnership. There was no death or divorce, but it was an opportunity to separate the partnership and then to be able to reinvest at a time that makes a lot of sense. So Jake Miller, what do you think on those 5 Ds, right? You got death, divorce, diversification, debt relief, and destination kind of freedom. What are your thoughts on those, Jake? Anything come to mind?
It's incredibly important that people realize that what we're doing here is we're helping liberate them, just like you're saying, Brett. Freedom to be able to reinvest the way that they need and that they want. Overall, and literally to not waste anybody's time, like literally in the first 5 minutes. Let's see. Can you hear me better now, Brett?
I think so. Yeah, you were getting going a little bit there. Yeah, but yeah, maybe no video, might be better.
Sorry about that. Yeah, just moving in between places. I left Guadalajara last night in a car. I've been driving across Mexico, so forgive me for my lack of great signal today. But to your point, freedom, or helping individuals find the freedom to be able to reinvest without having to pay taxes, is kind of like our main goal. That's what we're here to do. We're helping people know and understand how they can reinvest net of attorney fees rather than net of taxes, and the margin between is huge. Literally, it's typically a no-brainer if people are subject to taxes. And when I say subject to taxes, like in a big way, such as are having $1 million transaction or higher, or having a very big tax problem, so to speak. We're here to help solve that problem.
Yep. And Pierce, what kind of assets do these work for?
So what's nice is that they work for a variety of different assets, unlike some of the other strategies like a 1031, where it's, really mainly real estate. This works for a business. It works for stock. It works for crypto. It works for real estate. It works for primary home. It pretty much works for anything that's highly appreciated.
Yeah, and what's cool about it too, it's a proven track record too. Like there's others that are let's say imitators, but haven't duplicated it. And the really incredible thing about it is it's 27 years, thousands and thousands of closes, billions of assets sold using it, and over 24 no change IRS audits. And so part of that gives us certainty of conviction on what it can do, what it is, also what it can't do, and why some of the other ones don't work. Such as sometimes the other ones come out and say, oh, you can be your own trustee. That's one of the tenets of what you can't do with the deferred sales trust. So if you're looking to be your own trustee and have unilateral control, it's not a good fit because it doesn't work for the deferred sales trust. We offer third-party trustee services. That's part of what we do at Capital Gains Tax Solutions. And then we work with also third-party financial advisors. And so if it's something that where you want to be actively trading and doing everything yourself, that's also part of what makes it taxable. So we use third-party financial advisors like Jake Miller, also Jake Carpenter's on the call as well. So these are the things that that make the deferred sales trust work. It works for assets of, it could work C Corps. We're doing a C Corp sale working on a C Corp deal, looking at it. And what's interesting about C Corps, especially places like California, is if you go to, it's really efficient, like in the beginning or during your, let's say, building of the business. But when you go to exit, it's almost like double taxation. It's like even more. And so it's high as 67% was the estimate from the CPA. And so they're looking at the deferred sales trust to help them in a tremendous way versus not even going to sell it. You're not even going to sell the asset or sell the C Corp. They're now going to sell it. And I actually just did a video on C Corps that we're releasing on YouTube this week about that particular topic. And so if you're selling a C Corp, we're even more valuable because most cap gains tax and depreciation recapture is like 25 to maybe 50%. But most of the time, let's say the average is about 37% California, 40, 45, with New York and different things, depreciation recapture. It can be as low as like 25 if you're in a state like Texas, which doesn't have a capital gains tax, or Florida. But you have the federal of 23.8 for Obamacare. So 25 to 30 is kind of probably the lower end. 37 to 40 is probably the higher end, but then you can get as high as 67% depending on how you've structured your C Corps, which is absolutely kind of wild to think about how much can be wiped out. But you've got the tax savings prior to. Jake, you want to add anything about that with the C Corp so people can understand that?
Well, with a C Corp, people need to know and understand that all to the valuation of the shares of a C Corp. And it's actually the shares of a C Corp if you're doing a stock sell that you're selling. And again, we have to analyze the situation because in every scenario, Brett, sometimes we let the C Corp dissolve and we sell assets. And so every scenario and every situation is different for every buyer and seller. That's why we come in with a team of people to analyze what is the best and most optimized scenario.
Yeah, very well said. Yeah, exactly. And by the way, this particular one we're looking at, it seems like it's definitely going to be more favorable if they do the stock sale or the share sale, right? Versus the asset sale for a number of different reasons. But let's just say the CPA was very impressed and it works great. In fact, Jake and I just closed a C Corp deal, about a month and a half ago now, and for the Colorado client. And they were really hesitant. They were like, "Whoa, I don't know how we're going to get around the not round is not the right word. I don't know how it's going to work for a C Corp, the DST." And we walked them through it. And once they saw it, they go, "Whoa, it's even more valuable than I thought it was before," which leads into the next kind of topic, which is how to make the deferred sales trust an investment and not an expense, right? So the first thing is not only the capital gains tax that you're deferring. So in this scenario, it's like, 67% for this particular C Corp seller. So that's one thing. That's the money that's going to be working for you. It's going to be invested. It's going to be hopefully producing some cash flow, some appreciation. You can live off the full amount versus the after-tax amount. And then you'll also be able to diversify, probably give you some peace of mind, perhaps, or a little less stress if it's all tied to one business or one piece of real estate, and or even like cryptocurrency, for example. You want to be able to diversify, and that can create some peace of mind, which is very valuable. You could say that's kind of priceless, but Jake Carpenter, what's the peace of mind to have some diversification in a times like this?
Right now, it's more important than ever, especially if you're over concentrated in one particular asset class or one particular location in the country. You could be over concentrated in stocks, and you've got a lot of it, capital tied up in one real estate project in one state in the United States, and this gives you the ability to liquidate the stocks and liquidate the real estate and create multiple investments in different parts of the country, where you can spread out your risk and take advantage of diversification on a whole new level.
Yeah, and that's part of building a capital gains tax exit plan. Is not only how do I defer the capital gains tax, how do I maybe eliminate the estate tax, but it's actually how do I take the capital and the wealth that you've created or built, and how do you be a great steward with that by being able to diversify and or replant new seeds? There's a time to plant, a time to cultivate, and a time to harvest. And it might be a perfect time to harvest your asset that you're selling that's highly appreciated. And now you have more seeds or more capital, let's say an extra 30 to 67%, depending if you're selling a C Corp or not. And that amount, those are like seeds that can go into these other investments that can start to grow, right? Start to grow and produce cash flow, or some of them are for appreciation, some of them are in growth, and some of them for immediate cash flow. Some of it's just sitting on the sidelines in T-bills. That's, I think, around 4%. Maybe they're going down a little bit lower, maybe 4.5 or 3.5. I'm not sure, Jake Miller, what you think about that. But the point is, you get some liquidity, some diversification. Jake Miller, talk to us a little bit about what you're seeing in the marketplace for those that are wanting some security and some liquidity right now.
Absolutely. Quite often we do a diversified portfolio, or sometimes, as we have most recently in the last few months, we've helped secure people's assets in less volatile securities such as treasury bills. So you're right on, Brett. Occasionally, if your vision or your holding pattern, so to speak, in something that is liquid, such as marketable securities, is long term, we do move right away into some high dividend producing stocks, so preferred stocks. And we do that because they're less volatile than common stocks, as well as it's kind of like investing in multifamily, in the sense that there's lots of doors, there's lots of income, there's dividend from lots of different stocks. We put together a top 40 pick portfolio, what have you. There's a lot of different strategies, Brett. A lot of it rolls down to objectives and time horizon. When people are going to need that liquidity, which in this case with the deferred sales trust, sometimes we have payments that come out, interest payments that come out to the individuals. And so sometimes that needs to be available pretty quickly, pretty soon. But everybody's goals and objectives for reinvestment purposes are different, which is why we also bring non-marketable securities to the table. And I'm sure that we can talk about that as well, where we have some of these private investments, private equity or venture capital funds that are available to individuals. So a lot of things out there for people. Again, it all boils down to your liquidity requirements and needs, as well as your reinvestment objectives.
I want to touch on that a little bit, Jake. So the stock market part of it, right, with the dividends. So top 40, for example, I'm just curious, if someone puts $1 million in the top 40, what would be the average dividend or cash flow, if you will? Think of it like if you own an apartment complex and you're getting cash flow and you're getting, your monthly net is, NOI, your NOI. So Jake, what would you say that kind of the NOI per month on the top 40 dividends right now would be?
So that can be adjusted based on somebody's risk tolerance. So let's talk about the weighted average rate of return. You have some of these preferred stocks, Brett, that are paying 10%. That's pretty high. That's kind of like a high risk dividend producing stock. You have a lot of them that are paying like 2%, right? And so there's everything in between as well. What we can do, we can adjust it based on the client's needs. And of course, nobody has a crystal ball, but we can be fine tuning it as we go. And that's kind of our job as managing the portfolios, to make sure that if somebody's looking for 8%, 9%, 7%, that we're not incurring more risk than is necessary to provide them with that income that they wish to have, if it's every month or every quarter.
Excellent. And that moves into the next part, which I'll bring Pierce in for. So Pierce, if someone can sell high, diversify their wealth, get liquidity, pay off their debt, right? Obviously defer that capital gains tax, and they're waiting to find a piece of real estate. And Pierce is an expert in commercial real estate and luxury real estate in the Newport Beach, Southern California area. So Pierce, now they find a deal which someone had overpaid for, which absolutely happened in California for many years, it feels like. And there's some opportunities that are coming along. So walk through how somebody might take advantage of now finding a real estate property, investment property, right? And partnering with the trust to buy it.
Yeah. So what's really cool is that typically with like a 1031, you have this time constraint issue. So you only have 45 days to identify and 181 to close it. And it's like pigeonholes you. You got to go back into real estate when you want. With the flexibility that the deferred sales trust gives you the ability to control the timing of things. Not only that, but when you find a deal, right, that's actually good, you get a brand new depreciation schedule with it. And the way that works is you basically would set up a new LLC, and then you would go ahead and you would do a JV, a joint venture with your trust. And what's even cooler is that we can structure it in the most advantageous way for you, depending upon your unique situation at the current time. So a lot of times what we'll do is we'll structure it at 80% ownership to you for the sweat equity. And then the trust will come in at 20% and they'll put up all of the funds or, for the down payment or all the funds for, purchasing it if you have enough in there. And that depreciation and that cash flow will flow through kind of like accordingly. And there's different ways of structuring it so that we can, catch more of the upside if necessary or whatever. So, but the basic mechanism is going to be, you're going to set up a new entity. You're going to JV with it. The trust is going to put up the capital to come in. You're going to put up the sweat equity. And then from there, we're going to determine the best way percentage wise and all that kind of stuff based upon your unique situation to kind of structure it. Does that
Very well
answer the question,
said,
Brett?
Pierce. No, you nailed it. You nailed it. And I think that's the biggest thing. It's like really clarifying your need as an investor. And I feel like for my real estate people, and that's my strength is real estate. Grew up in the real estate development business, brokerage business. I'm still a broker, still an investor. That's my main area of expertise. I found that the biggest need for my clients has always been optimal timing. It's always been buying a deal when it makes sense or being able to strike when the deal makes sense, having enough liquidity, having enough debt paid off so they can actually qualify for debt, right? They're not they have so many assets and so much debt on them that they can't qualify for new debt or bigger debt, but basically being able to consolidate and pay off their debt, consolidate their equity, and be able to strike when the iron's hot. And the old Blockbuster way of doing things, you'd have to sell and try to 1031. You'd have to either sell and pay the tax to even shift between different marketplaces. And so that need of timing, that need of diversification, that need of liquidity, that need to strike when the iron's hot is the big challenge that the deferred sales trust solves for. And so if the ideal outcome is to Brett and Pierce and Jake, we want to be able to sell high and buy low. We want to be able to sell high and buy on our own terms. We want to be able to build a capital gains tax exit plan that fits into our wealth plan, our legacy wealth plan. And we want these things to be work congruently, right? Not against one another. And we want to be able to have, maybe passive freedom to be retired or entrepreneur freedom to start a new business venture. That's what the ideal solution is for the deferred, or we think the deferred sales trust is an ideal solution because it bridges those needs to where you want to be, right? And oftentimes, the need is, let's say I recently watched, I think it was Vanderbilt, who was in the steel, and he was the one who discovered how to do like steel bridges, which changed the world in a lot of ways. In the Missouri River was the big river that everyone was trying to figure out how to get over the top. And so he built this steel a bridge across, and it like changed for everything, right? Well, that's the challenge, right? That steel bridge where your need is to get to the other side, but that steel bridge, you need something to be able to help you with that. And that's part of where we would love to come in. We do come in and we provide that ideal team with the solution to execute it. And so the big question is, if you're listening to this, is if we could help you achieve diversification, liquidity, optimal timing, new depreciation schedules, ways to build wealth in a way that unlocks the freedoms you desire, would that be of significance to you? How would that be helpful for you? Would that be worthwhile for you? Would that be important for you, right? We have clients that are selling and wanting to get the freedoms of location and time with their family out of California, out of New York, out of New Jersey, who are retiring after owning assets for many, many years. And this is their family legacy. And part of that is deferring that tax, but also having that team they can trust to help them build the wealth in an efficient way. And so if it could be of value to you, we encourage you to join us and hear what we have to say. That being said, I wanted to open up for questions now. We've had quite a bit of content here for about 24 minutes. So if anyone has questions, you can put it in the chat. You can also unmute yourself. And by the way, if you want to take action right now, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also connect with Jake Miller and Micah. Maybe you want to also chime in here. It's a good time to maybe kind of recap what we've been talking about. But Micah and Jake can be connected at strategictaxsolutions.com. And then we'll have Jake and Pierce tell them where they can be contacted here in a few minutes. But Micah, what are your overall thoughts? maybe start fielding some questions, or maybe questions or thoughts that you might have based upon what we just said.
So, I mean, a lot of just the diversification that you get with this type of an asset, right? I mean, I love how you've structured it with the D's, right? I mean, you need to kind of make a slogan and a t-shirt with that on there, I swear, because those are the big pain points. And really, you have to keep in mind, what is the solution? What is the problem? Why is this needed? You know, I mean, if somebody's going to take all of the proceeds of a fund and they're going to use them all, then that's great. They can use them all and they can pay the taxes on them as they use them at that time. But if they're not ready to be taxed on all of this, all of the sales, the proceeds at this time, they absolutely have that option to defer it and delay it, even more so than just a simple 1031 exchange, because then you're also getting the diversification of other assets than just real estate. You have the diversification of going separate ways from different partners. It's just pretty neat.
You know, Micah, I couldn't have said better myself. In fact, I think it actually sounds better. The female touch also adds, because there's a lot of guys on this, on this talk. So I appreciate the wisdom and the clarity, and I can tell where Jake gets his skills. That's the Jake Miller, by the way. If you didn't know, Micah and Jake, they are the married couple here, and you can tell where Jake gets his skills with communication. So well done, Micah. By the way, I also want to brag on Jake a little bit too. Both Jakes, actually, both Jake Carpenter and Jake Miller. Some of their skill sets, Pierce York too, actually, let me just throw in there. Ability to ask useful, powerful questions, right? Part of what separates what we believe our team from other teams is not only the diversification of thought, but also the diversification of strengths. And the ability to ask useful and powerful questions is so important when you're looking for a team to help you level up to the next level. And I want to just applaud Micah, Jake Carpenter, Jake Miller, and Pierce York on your skill to ask useful and powerful questions. It looks like we do have another question coming in. Micah, do you want to read that one? Perhaps?
Yeah, so this one came in from Ed. Ed's got a portfolio of some small homes and he wants to convert to a combo of syndicated deals and direct investments. Can the DST vehicle apply to the corporate investments on the outbound side of the transaction simultaneously?
Okay, it's kind of a big question. It looks like a good question. Ed, do you want to unmute yourself and say hello, and we can kind of walk through it a little bit?
Oh, hello. What I'm looking at right now is simplifying my portfolio and moving to more passive. And I'm looking at a lot of deals right now. I want to put some into some direct investments for businesses, as well as a couple of syndicated deals that I'm looking at. So
it sounds like you've got some investments now that you want to sell, maybe a little more passive, or just diversify your wealth a bit. And what is the major thing that if you were able to accomplish what you want to accomplish, what would it look like for you?
Well, from my perspective, it's going to simplify my life, because I'm right now hands-on these things. And if I transfer it to management, the margins on those go way down. It doesn't really pay. It just becomes a long term. So I don't want to lose the cash flow, but moving it into some of these other things will do that, but it'll still simplify my life, as well as deferring the gains on it. So
it sounds like it simplifies your life, and it maybe frees up some of your time and energy from having to do the day-to-day management or maintenance or all the stuff that's associated with owning the real estate.
Right.
Okay. I'm curious, where are you located at, Ed?
I am in Michigan right now.
Okay. Excellent. And a couple other quick questions too. How many assets are you looking at selling? And then what's the average gross sales price?
I believe, I'm not sure exactly how many I will disperse. I think probably 6 properties with 10 to 12 units, depending which ones I select.
Okay. And are they single units, or are they multifamily, or mix duplexes?
These are all multifamilies, 2s to 4s.
Okay, great. And then what would you say the average, for the ones you were considering selling, what's the average sales price?
maybe 250 to 400,000.
Okay. And then what's the average debt on those ones?
I would say we're about 45% LTV overall.
Okay. So 45% of, so let's just call it 50% debt, 50% equity. What's the average gain, would you say? How much have you appreciated?
At least half of that. Some of them are probably, some are tripled, and some are, I haven't held very long, so they're probably 50, 60%.
Okay. And can any of them be packaged together and sold all in one escrow?
Could be. Right now there's a offer on the table for something like that.
Okay. All right. It could be a fit. Generally speaking, I want to pass it over to Jake Miller and see what questions he would add to this and kind of his thoughts so far.
You talked a little bit about your reinvestment objectives, trying to be a little bit more passive. Do you have anything in mind currently, or you just want to have the liquidity for the next deal that might come across?
I've got some deals in mind. One is closing pretty quickly. Yeah, I got, it's an open time horizon, but there's an incentive to get in early, and other ones are always coming across my table. So.
And my sound cut out for a little bit. Did you mention the total value of the package or the bag of properties?
That's a good question. I think it running about maybe 2.1 million for the package, with appreciation probably about, well, I guess the net out would be about 1 to 1.2, and appreciation is probably about 800. Oh, sorry. Oh, yeah, about $900,000 overall.
Okay. And when do you, I know that this other opportunities in the near future, timing, there's some benefits there, whatever. And there might be an offer on the table for the whole package, or, your portfolio of real estate as it is right now. Do you have any letters of intent, or are these all just verbal conversations?
They're verbal conversations, but one of them is from a realtor / partner that I work with. So it's under pretty good advisement.
Okay. Just from our perspective, this would work better as a package than individually one-offs. It's more seamless as a transaction in regards to the dollar amounts that you're speaking about. Now, if each deal was $1 million, then that would be a different story. But being that the package together is just over 2 with $1 million, $1.2 million in net, that
right.
Works a little bit better for us and for you, so that you're utilizing one deferred sales trust to reinvest in other projects.
I would also ask, if I can jump in there.
Go ahead.
How are these structured? Where are the entities being held, and what type of structure do you have around them?
Well, that's a good question too. These are all held individually in my name. I just kind of started out that way, small, and had no equity. In the last few years, it's really blossomed out. So and I realize it's not in the right legal structures to protect myself, but that's what it is. So it's time for me to move, and this would, rather than moving them into the right structures, it might be a way to achieve some more of my objectives.
Sounds like you're really trying to upgrade.
Right.
It's good, Ed. No, that's very helpful. So yeah, I think it could work. You could schedule a time with us to kind of dive in a little bit deeper. But what initial questions or thoughts do you have at like this point? What's the number one that you're like, I really got to know that?
I guess I'm looking at the tail end of the transaction. What's my tax liability? If it's zero, that would be great. Even if there is some, because I've got some cap loss carryovers from previous syndicated deals I've invested in when I refinance some of these properties. So,
okay, so it looks like you have some carry forward loss on the table now that you think you could use against this.
Right.
So that's actually another good point here. You want to make sure you find out what that amount is. Do you have any idea what that amount is?
I believe it's about $90,000.
Okay, so it's not that big, but still, that could be a good. We could structure it where we send you a payment at the beginning that could offset. You could use that, so you don't lose out on the opportunity to have that, and that could save you a little bit in fees too for the ongoing fees. So that's something to keep in mind. You always want to check to see if you have carry forward loss that you can offset on your current sale. Being this is only 90, it's only a small amount of your total sale. 90 is substantial, but small in comparison to the total proceeds coming into the trust. But it can still be you can still use both, is what I'm saying. So, okay. Now, I think you're referring to, your question was, well, how do I finally get out? Like the exit? Is that what you're referring to, Ed? Like long term?
Yeah, I guess that as well.
Yeah, so it's definitely tax deferral. It's not something where it just, unless there's like a tax holiday where someone gets into, the laws passed where there's a tax holiday where it's 0%, right? Cap gains tax, then you can get out in that given time. Not likely to happen in that given year, but the other thing is true, as you get out, it could go higher too. So something to always consider both sides of that. However, most clients in your scenario, let's say $1.3 million hits the account, they just keep that principal intact and just live off the interest payments, right? And so they look at 1.3 million, and let's say it's about 8% is the promissory note on the 1.3 million. That's about $104,000 per year, or about $8,600 per month. And so that's the cash flow that you'll pay ordinary income tax on. Most won't dip into the principal, but if you do dip into principal, that's when you'll pay capital gains tax and the depreciation recapture. So you fall on that, Ed?
Not all of it.
That's okay. Yeah.
So,
I think it'd be good to see your overall cash flow scenario right now. Like, what are you cash flowing now? How much time and energy does that take up for you, right? Versus what it could be for the deferred sales trust. Compare the two, right? And to see what's a good fit. Number two, you want to look at if your debt's in an adjustable state or a potential adjustable state after a fixed period of time, what would your cash flow be if that rates were to adjust? We're working on with a client right now.
right.
They have a very low interest rate and they're really happy. But in about a year and a half, two, it's going to readjust. And if it readjusts, it would drop their overall cash flow per month by about 5,000. It would increase by a couple points. And all of a sudden, it's not such a great deal anymore to hold. And so that's something to consider as well. You might even want to sell now because you could have somebody assume your debt, which could actually probably get a little bit higher price than the current marketplace is because debt went up so quickly. So you want to make sure you work with a great realtor who can understand and analyze your properties, analyze your debt situation, and see if they're assumable so that you could sell at a higher price. Is that making some sense, Ed?
Yeah, because that's a good point too. 6 of these properties have, because it's being held individually, so they're sitting out there on traditional mortgages that are somewhere between 3 and 4 and an eighth percent for the next 25 to 30 years. So,
if it's so, find out if they're assumable. If they're assumable, that's huge.
They're not assumable.
They're not.
From what I can tell, but I could probably look at it a little closer and see.
Okay, good. All right, Ed. Well, I think we did a pretty good job today. I don't know, any last thoughts? Maybe even from.
And 2 of my properties, well, one of them is free and clear, and another one is pretty close. It's about 75%.
What's your highest priced property that you own?
Is a 4-unit. I have previously. I'm trying to figure out what the right price is for it. Somewhere between $360 and $420, I think, right now. So. Okay,
what do you owe on that one?
1.25.
And what's the basis on it?
I bought it for $140.
Okay. All right, and you've had it for
9 years
how long?
ago.
How many?
9 years.
Okay.
9 years.
So your basis is probably like 100, maybe 890 or something like that.
And the building is old, so yeah, there's land value is majority of it when I bought it. So,
Okay. All right. The other thing too is you want to try to, if you can, pay down your debt to your basis on all your properties. That's going to make it a lot cleaner. So one things you could prep before the DST is having your debt equal to your basis. If your debt is above your basis, we cannot defer that. That's taxed as ordinary income tax. Now we do have a way to partially solve that, or to definitely solve that if you're an accredited investor through what's called a Delaware zero coupon deal. You can go and look up using two DSTs on my YouTube channel to kind of talk about that. But in the meantime, if Ed, you have the ability to pay down that debt to your adjusted basis number, the 120, let's say to the 90, pay down that debt when you can, so that when you sell, it's the same. And therefore we can defer basically 100% of the capital gains tax and depreciation recapture. That's a little bonus for everybody there. Go back and rewind and listen to that one again so that you get that. But that being said, Jake Carpenter, you want to add anything, subtract anything? We haven't heard from you in a few minutes here.
No, I mean, I think the overall amount that's subject to capital gains tax, I was hearing is about 800,000. Is that correct? Did I hear that correct?
Yeah, 800 to 900. He thought, yeah, was the gain.
900.
Right.
So, it's a doable deal. It's kind of like Jake Miller said. It's more efficient to have it done in a package deal. But those are the things our clients want to do. They want to take deferred proceeds and go back into other real estate deals, syndications, whether they be passive or active, but they want to go into those real estate deals nonetheless.
Yeah. And by the way, Michigan's 4.25% for capital gains tax. It's taxed as income. It would be their income tax, right? So you had 4.25 plus 20 for federal. That's 25 plus another 3.8. That's about 29. And then you add any other depreciation recapture. We like to use 2 to 3%. So about 30, let's call it 31% of the gain, Ed, would be your liability. So if your gain is 900,000 and we were to use 31%, that's 279,000 of liability. Hopefully that's helpful for you, Ed. Check with your CPA. Happy to schedule a call. That being said, anyone else have any other questions and or thoughts, hesitations? Please unmute or put it on the chat. We would love the opportunity to answer and help you out today.
I would make one other comment that to schedule a call with Brett, either of the Jakes, it doesn't cost anything to do that, to explore your deal a little bit more with the attorneys, because the attorneys aren't on this mastery call. They get on in the deals themselves.
Well said, Becca. Yeah,
Okay.
exactly. Everything is no cost, no obligation for tax attorneys, our business partners, and then all of us as well. And if you do the deal, do we get paid? So very well said. Anybody else? Pierce, Jake, or Micah again. This is cool.
No,
There we go.
Okay. Well, I just want to say thanks. It sounds like good advice, and I might add in a couple of my other partners as well and bring them into the same session so that they can understand it. So
Excellent. Yeah, appreciate it. Happy to help, Ed. All right. So that being said, I want to thank everybody. I think we're pretty much wrapping it up here. Hope you have a great Friday. And I want to encourage you guys all to take action right now. You go to capitalgainstaxsolution.com to get started. As well, look for the new book on April 20th. Remember the Kindle version. The Kindle version is completely free for 24 hours on April the 20th. Download it, okay? If you want to get the hard copy as well and support, feel free to get that. Say hard copy, but the physical copy, because it's not a hard cover. It's just the soft cover. I think we have to sell like X amount of books to get the hardcover. Anyways, check it out. Amazon, Building a Capital Gains Tax Exit Plan, capitalgainstaxsolution.com. Pierce York, if people want to get in touch with you, where can they find you?
Yeah, you can find me at kingdomluxuryrealty.com or Living in Newport Beach, California YouTube channel.
Awesome. Mr. Jake Carpenter, if people want to get in touch with you, where can they find you?
You can email me at Jake, Jake @carpenter.capital.
Excellent. And Mr. Jake Miller and or Micah, if people want to get in touch with one or either of you, where can they find you?
We have a wonderful little website, strategictaxsolutions.com, as well as an 800 number, 1-800-773-1848.
Fantastic. Thanks, everyone. We'll talk to you again real soon. We'll promise to do better next time. Bye now.
Bye-bye.